JP Morgan is facing a critical liquidity event as it is forced to cover massive short positions in silver and other precious metals. This is not speculation. The numbers behind the scenes show the bank is under pressure from regulatory mandates and market realities that can no longer be ignored. For years, JP Morgan relied on naked, short positions, counting paper contracts as real assets, manipulating prices while holding minimal physical metal. That era is now over. Basel III regulations combined with NSFR rules have made holding these shorts extremely expensive. The cost of carry has skyrocketed. Banks must now allocate significant capital to cover positions that were previously leveraged with minimal oversight. Overnight, internal memos and trading desks reported a rush to buy physical metal to reduce exposure. This creates immediate upward pressure on silver and gold prices, driven by compliance, not speculation. Every ounce purchased reduces availability in the market, tightening supply and forcing competitors to react. Hedge funds that relied on borrowing from JP Morgan for their short positions are now forced to liquidate or cover at a loss. The ripple effect spreads across global markets. Depositories and industrial buyers are caught in the middle. Industrial firms previously able to secure metal for production now find inventories thin as banks prioritize compliance. Retail investors are observing price surges but remain unaware of the underlying cause. The Fed's mandates require banks to adjust balance sheets immediately or face penalties and increased capital charges. JP Morgan cannot delay without risking regulatory scrutiny and market destabilization. As the bank covers its shorts, physical metal is being absorbed at record rates. This is creating a feedback loop. Buying pressure drives prices higher, which forces additional covering, which drives prices even higher. Market algorithms and high-frequency trading systems are reacting to these sudden spikes, amplifying volatility. The wider banking system is also affected. Other major institutions must react to maintain parity and regulatory compliance. The domino effect is unfolding. Global metal exchanges report declining available physical inventories. The London Bullion Market Association clearing banks are seeing unprecedented demand for delivery. Prices are spiking across multiple time zones. Depositors with unallocated accounts face additional risk. Banks prioritize compliance over client convenience. Letters instructing conversion to cash or physical delivery are being issued. Those who ignore warnings risk being caught off guard. The market is moving faster than ever, and traditional indicators are failing to reflect the urgency. JP Morgan's short covering is the catalyst for a broader realignment in the precious metals market. Industrial users, sovereign funds, and retail participants must now adjust strategies. Physical possession is paramount. Paper holdings or unallocated accounts are exposed to forced conversion or liquidation. Every move the bank makes decreases available supply for everyone else, driving volatility and panic buying. Traders on COMEX and other exchanges report increased margin calls. Hedge funds face massive liquidity constraints. Those relying on borrowed metal for speculative short positions are closing trades at a loss. The feedback loop continues, and prices rise as demand outpaces supply. Depositors are now keenly aware that unallocated accounts are vulnerable. Banks have no incentive to maintain paper holdings that count as capital but fail to comply with new regulations. Every ounce moved from paper to physical reinforces the new market reality. The Federal Reserve and regulatory authorities have effectively rewritten the rules. Compliance is now mandatory, and banks must act first. Timing is critical. Early positioning allows some participants to secure holdings at current prices, but delays risk exposure to higher costs and limited availability. Physical hoarding by banks is the primary driver of the current volatility. Retail investors and industrial users must adapt immediately. Statements, dashboards, and traditional reporting may mislead, but actual possession of metals ensures security. Prices will remain elevated while the banks complete their covering process. This is a pivotal moment in the market, not speculation. Regulatory mandates, Basel III rules, and NSFR enforcement are driving systemic changes. The short covering by JP Morgan is both a symptom and a catalyst. It exposes vulnerabilities in the global banking system while forcing a transition to physical-backed assets. Depositors, investors, and industrial users must recognize the new hierarchy. Banks first, industrial users second, retail last. Awareness and action define advantage. Every transaction, purchase, or delivery reduces available supply and increases prices. Market volatility is no longer purely sentiment-driven. It is structural, regulatory, and mechanical. Those who ignore the new reality risk being excluded from access to essential physical assets. The alert is active. The situation is unfolding rapidly. JP Morgan is moving aggressively to cover positions, and other institutions will follow. Industrial buyers scramble. Retail participants must adapt. Physical possession defines security. Paper accounts are exposed. Timing, awareness, and action define advantage. The Federal Reserve's regulations are enforcing compliance and reshaping the market. Short covering continues. Prices rise, volatility spikes. Every ounce matters. Every move matters. The hierarchy is clear, the law is active, and the market is reacting. Those who understand and act early can secure positions. Those who ignore the signals risk losses. Physical metals are paramount. Compliance drives behavior. Banks act first, industrial second, retail last. The alert is real. The crisis is structural. Timing and awareness define advantage. The market has changed forever.